For my new subscribers, I do videos every single day. I usually do 3. And if you look at the bottom of your screen where it says the description box of the YouTube video, you will see I have a link there titled Today's Playlist. If you click that link, it will bring up all 3 of my videos and they will play one after the other to make life easier for you. Okay, OurFiniteWorld.com is a blog by Gail Zverberg. And boy, oh boy, does Gail put the data out there for all to see. Raising interest rates cannot end well. With an exclamation point for a bonus. Apparently, we don't need no bonus. We know all about the interest rates and how it ends. And considering that by the time you see this video, it will be Wednesday morning, the day the Federal Reserve gets out of their little meeting, which started today, Tuesday, and says, okay, we're going to raise interest rates or we're not. Now, if they plan on raising this year, which they've said 3 to 4 times possibly, and since we have quarters, right, each year is divided into quarters or fourths, that would possibly imply, 4 interest rate hikes for each quarter. And here we are in March, first quarter. Tomorrow I would expect interest rates rising. Next quarter, same thing. Next quarter, same thing. Next quarter. That's what we would expect. Again, the guy I told you about yesterday that has the crash guru guy that has called them all right, including the 2015 flash crash of the Dow that dropped like 2,900 points. He called that too. He has called for us to watch March the 13th, which, as you know, was Monday. He didn't say that was a crash date. He just said watch it for signs of, like bad news and market going down. And the Dow finally, off this huge winning streak, down 20 points. Not a big deal, 20 points. But today, I think it was ended around 40 points. On the way home, I heard the radio. I think it was 40 points or 41, somewhere around there. So that's 2 days in a row from the day he said to just look. And he said, don't worry about that anyways, because after next month, April, is May. And May 11th, according to him and his cycles, is a really important time frame. Like, I'm more concerned about that than this March 11th thing. March 11th thing, don't worry about it. It's the next one that we really need to see what happens with the market. Well, coincidentally enough, at the very end of this month, March, Brexit vote has happened, Article 50, and they'll be leaving the European Union. The UK will be leaving officially the European Union at the end of the month, which again is just a few days before May 11th. We now have, as again today, interest rate day. Fed, they are saying it's 100% chance that they'll raise now. The other thing, one of my favorite things that hasn't happened in a while to talk about, debt ceiling. Are they going to raise it? Or are they not going to raise it? Are they going to let Donald Trump do it? Or are they not going to do it? Are they going to try to make him look bad? Raise the interest rate? Stock market start going down? Nail him with the debt ceiling? I mean, what's going to happen? Don't know. We're going to find out. But this article, again, there's a lot of very good data points in here. And it's kind of a long article, and maybe I don't have to cover all of it. I can kind of point out maybe the most important things. But again, this is the kind of stuff I love. Show me the data. Don't show me the talking jerk on TV, the supposed expert. Raising interest rates can't end well. The Federal Reserve would like to raise target interest rates because of inflation concerns and concerned that asset bubbles are forming. Part of their concern seems to arise indirectly from the rise in oil prices relative to their low level in early 2016. A finite world does not behave the way most modelers expect. Interest rates that worked perfectly well in the past don't necessarily work well now. Oil prices that worked perfectly well in the past don't necessarily work well now. It seems to me that raising interest rates at this time is very ill-advised. These are a few of the issues that I see, she says. Number one, the economy is now incredibly dependent upon rising debt to prop up its spending. The pattern of total debt to GDP for the United States is shown in Figure 2, which I've just discussed this again recently. But as I said, I'm finding more and more articles hitting of the same stuff. So as I said before, if these were every great once in a while, I talk about debt to GDP, it's every great once in a while. But when there's a pattern of, okay, there's new stuff on it, there's more stuff, and I'm talking about more and more and more, it's not just because I feel like coming out here and talking about it. There's some new data, some new information. Even though some of the charts that they use to make a point may be the same as the last video I did or whatever, but point is, faster, until we climax into whatever it is. What's the climax? Where's the peak? And I think we're getting there quick. Are we going to actually wait till September, October before the big one hits? Maybe not. It may be here sooner than that. Matter of fact, it could come and go again. And then we're in 2018. Hey, nothing happened. They held it together again. But I can tell you one thing for sure. When $4 of debt has to be created to produce $1 of GDP, that not only doesn't end well, it's pretty much baked into the cake, so to speak, mathematical certainty, that it will have to be dealt with. And being dealt with is going to be horrible because it's a debt bubble that has to burst. I'm telling you, they will devalue this dollar sooner or later. Donald Trump has said it himself. Recently, Treasury Secretary Mnuchin, dollar's too strong. They're telling you. So we're going to raise the interest rates. What happens to the debt payment? Well, we got to pay more money on it. Us citizens, taxpayers. But you guys want to raise the defense budget. He wants to spend infrastructure. We're talking trillions. And if they kick this debt ceiling can down the road again, you may find, listen to this, you may find that if you thought Obama, the debt ceiling got high under him, 10 trillion equaled 20 trillion by the time he left, will be nothing compared to what's going to happen next in the next potentially 8 years, hell, even the next 4 years, if they kick that can that long. I don't know if they can, or I don't know. We're going to find out. But again, if you look at this chart, U.S. debt to GDP ratios, this is overall from 1945 to 2016 or so. And when you see the last 3 years, this gigantic, enormous red line, that's a lot of debt being created. And again, that was Barack, 2008 president. He lasted 8 years, etc. This is not going to end well. There was a huge increase in debt in the period leading up to the 2008 crash. Every year between 2001 and 2008, the increase in debt was greater than 4 times the increase in GDP. So let's think about that for a second. We're not even talking about from 2008 to now, 2017. This is from 2001 to 2008. Well, 9/11, invade this country, invade that country, and again, military-industrial complex, as I said, does not get budget cuts. No, sir. It only goes higher. And matter of fact, we have a president right now that wants to spend even more than ever on the military, which means the military-industrial complex that supports the military as well. Goes hand in hand. In fact, for some of the years in that period, more than $8 of debt were added for every $1 of GDP added. We now seem to be starting a new ramp up in debt. In 2015, the amount of debt added was $2.5 trillion, 66.1 trillion minus 63.6 trillion, while the amount of GDP added was only 529 million. This indicates a ratio of over 4.7 for the single year of 2016. Number 2, the vast majority of debt run-up since 1981 seems to have been enabled by falling interest rates. Given how dependent we are now on large increases in debt to produce GDP, it would seem to be dangerous for the Federal Reserve to raise interest rates, right? Because if we're adding tons more debt faster than ever before, and again, more than ever before, that debt has to have interest paid on it by you and me. So if you raise the interest rates, it's like I said the other day, this is like a house that had the adjustable rate mortgage. Oh, it's $1,500 a month. I can pay it. And then in 3 or 4 years, I'll sell the house anyways. Market's going to keep going up. Only to find out the market didn't go up. You owe more than the house is worth now. Oh, and by the way, your letter just came in the mail. Your rates are going up. You owed $1,500 before. This little increase is now making you pay $1,800. Oh, I can't afford $300 a month more. I'm done. That's a stupid single mortgage payment. We're talking about the national debt at $20 trillion. What does one little interest rate higher mean for that? Huge, my friends, huge change in what we have to pay for that interest. Nothing changes. The amount, even if the amount stayed the same and just the interest rate went up, nothing would change except the amount you now, or not us per se, the government has to pay the bondholders, treasury bills holders. And a lot of that, believe it or not, is held by the Federal Reserve itself. Isn't that amazing? With falling interest rates, monthly payments can be lower, even if prices of homes and cars do, in fact, rise. Thus, more people can afford homes and cars, and factories are less expensive to build. The whole economy is boosted by increased demand, really increased affordability, for high-priced goods, thanks to lower monthly payments. Asset prices, such as home prices and farm prices, can rise because the reduced interest rate for debt makes them more affordable for more buyers. Assets that people already own tend to inflate, making them feel richer. In fact, owners of assets such as homes can borrow part of the increased equity, giving them more spendable income for other things. You might know that as a HELOC, home equity line of credit. Remember that? This is part of what happened leading up to the financial crisis of '08. The interest rates that the Federal Reserve plans to change are of a different type called effective federal funds rates. These also hit a peak about 1981. Number 3, the last time federal funds target interest rate was raised, the situation ended. Quick, look very surprised, like I'm looking at you right now, very surprised. Ended very badly. Whoa, really? Figure 4 above shows that the last time Federal Reserve target interest rates were raised was in the 2004 to 5 period. This was another time when the Federal Reserve was concerned about the run-up in food and energy prices. As I mentioned in my paper, Oil Supply Limits and the Continuing Financial Crisis, the higher target interest rates were somewhat slow-acting, but they eventually played a role in bursting the debt bubble that had been built up. In 2008, the amount of outstanding mortgage debt and consumer credit started falling, and oil prices fell dramatically. It is ironic that the U.S. government is again trying to bring down food and energy prices when they are at a price level similar to the price level when they tried this approach the last time. The Federal Reserve looks at its favorite metrics, PCE inflation and PCE inflation excluding food and energy. Oh, the things that matter the most, yes. From the high level, or this high level view, it is likely that they have no real understanding of exactly what energy price problems are causing the strange result. With this high level view, they do not realize that a big contributor to the rising costs in the increase in oil prices between the January to March 2016 period, when they were under $40 a barrel, and recent prices, which are above $50 a barrel. They are now back to below $50 per barrel, but this would not be apparent from the metrics, he says. When the high level view is used, it is easy to miss how low energy prices are today relative to the needs of energy producers. Most people who have been following what is happening in the oil industry know that prices are not high relative to the prices needed for profitability. Even if some U.S. companies claim to be profitable at $50 a barrel, it is clear that in general, the industry cannot withstand prices as low as they are today. At the current price level, investment is too low. Part of the problem is that oil exporters need higher prices if they are to obtain adequate tax revenue to fund their programs. For example, Saudi Arabia has found that because of its falling tax revenue, it needs to borrow money to maintain its programs. This is a big change from being able to set aside money in a reserve fund out of excess tax revenue. This is another place where the shift is toward more debt, more borrowing. Number 4, the pattern the Federal Reserve seems to want to follow is the 1981 model, in which temporary high interest rates seemed to force energy prices down for a long time. If we look at oil prices compared to U.S. wages per capita, dividing total wages by total population, we find that oil affordability was at a low point in 1981. We saw previously in figures 3 and 4 that interest rates were raised to a very high level at that time. The gray stripes in figures 3 and 4 indicate that a recession followed. I don't need to show you these charts right now. Figure 6 shows that after interest rates fell, affordability rose until 1998. So jack up the interest rates, claim you have to do this for whatever reason, but knowing in the background we need to cause a massive deflationary spike in certain assets, such as your favorite one, your house. So those of you who own a house right now, as I've been saying for about at least a year now, I've been saying this for a while, but I've been hitting it home for about almost a year now. The value of your house is absolutely, positively going down the crapper. It may not happen instantly. It may drag out, but it is going to happen. The trend as of now, recent times, as I've said and I've shown, down. The economic confidence model, Martin Armstrong, 2016, end of 2016, all the way to 2032. In 2025 is the normal 18-year cycle, which normally sees a giant devaluation in mortgages and hold on a second, in housing. Mortgage, because housing goes down anyway. So housing gets destroyed, mortgages come down with it. However, if you jack the interest rates up a good bit, you find that you're paying the same as you are right now, except most of the money is going to the bank. Most of your payment is going to now go to the bank, like the good old days. So the bank gets to create money out of thin air to loan to you, and then you pay the loan back with interest, while simultaneously looking at the value of your house being destroyed. Now, if you're locked into your house right now, locked in on that rate, whatever you have, well, you're okay. Except for the fact that the value of your house is going to be destroyed. But you may say, well, that's okay. I'm in at a 3.5% or 4% interest rate, whatever. I'm still going to pay it off in the same time frame I planned on anyways. What's the difference if I kept the house now, or I was able to sell it to high and go buy a house now with depressed prices? Well, the difference would be you got out at the top, made some money, houses crashed down. Now you go and buy a house and put a nice down payment down from selling your other house on that, even though the interest rates are higher, but you knock a giant portion of that off because you've made a nice down payment on it, and you get a house a lot cheaper. Yes, you still have a mortgage, but your mortgage will be better than it was before, even though the interest rate's higher, because you put a nice little lump sum down on the house. However, my plan, again, if I can, if the stars align right, and I think they're going to align right enough, to be honest with you, Bitcoin, precious metals, proper timing, unload those babies up. Just bought my house free and clear. I don't care what the interest rates are. Screw you, banks. I'm not coming to you for crap. I don't need you for crap. Piss off. Oh, and everyone else who didn't want to listen to guys like me and other people on YouTube trying to warn you when we Facebooked you, stop talking negative. Don't tell me that. I know, I'm trying to tell you to help you. Your house is going to be destroyed in value. Do something now. If you plan on, we're going to move in 2 or 3 years. No. Move now. Sell the house now. Rent for 2 or 3 years. Then move. And you can thank me later. I don't even want anything. Don't send me anything. Just thank me later when you see what kind of deal you get on your house later. So we have the Federal Reserve that so far is saying we are raising this year. And since Donald Trump's in the White House, we are raising this year. 4 times supposedly they want to raise. If they just do 0.25% each time, okay, by the end of the year, interest rates will have gone up one little piddly percent. But what's 2018 going to hold? Maybe they'll go more. Maybe they'll say, well, we don't want to do a 25 basis point. We'll do a 50 or 0.5%. We don't know. Generally, what they've been doing last 2 times was 1/4 of 1 point. So 25 basis points. This lady can see it. I can see it. Most of you can see it. And I still see the comments sometimes. Oh, nothing's happened in this long period. It's fine. Are you smoking hopium? Are you smoking hopium? Because you must be. Consumer confidence is high. That's funny. Consumer confidence is always high when the last stock market's bubble was right about to burst too. That's funny. Consumer confidence is high. There's no end to this. I'm telling you. OurFiniteWorld.com, Mrs. Gail Tverberg. Now, I've been talking long enough. I've read enough of this to prove the point. But there's a lot more she brings up and shows charts. I'm going to link, of course, this article in the description box for those of you who want to go here and check it out. Index of U.S. apartment and new home affordability. If they go down, it's a bad sign. Well, they're going down. I'm looking at it right here. Quantity of residential electric affordability using 3 measures of income. Not looking good. Another chart. I mean, it's all laid out right here. It is all laid out right here. And what brought me to this site was an article that quoted some of this from Zero Hedge. And their conclusion, essentially, Zero Hedge, which I'll end this with because it's short. Observations and conclusions. The economy looks to me like a type of Ponzi scheme. It depends on both rising energy consumption and rising debt. Judging from the problems we are having now, it seems to be reaching its limit in the near term. Raising interest rates will tend to push it even further toward its limit or over the limit. Debt is used to pay participants in the economy using a promise for future goods and services. This allows the economy to appear to distribute more goods and services than are actually available. In a way, adding debt is like being able to manufacture future energy supplies that can be used to pay those who participate in making the goods and services we produce today. When energy products are high cost to produce and delayed in timing, such as wind or solar panels, the need for debt especially rises. Part of our problem today is the extent of specialization of those analyzing our current problems with energy in the economy. This means that virtually no one understands the full problem, especially those who change the rules, up the interest rates, print the money, create the debt, those guys. Bankers seem to think that debt and interest rates on debt can solve all problems. Energy analysts think that energy resources in the ground are all important. They both create incorrect analysis of the overall problem. Rising debt is needed if energy products that have been created are to be absorbed by the world economy. The energy glut we are seeing are signs of inadequate wage growth. A major function of growing debt is to add wages. Unwinding debt leads to the kinds of problems that we encountered in '08. It is tempting for world financial leaders to think that they can find a solution to today's problems by using higher target interest rates to slightly scale back economic growth. I don't think that this is a really good option. The world economy is operating at too close to stall speed. The financial system is too fragile. If any solution can be expected to work, it would seem to need to be in the direction of restarting QE. Remember that? Quantitative easing? Even if it produces asset bubbles, it may keep the world economy operating for just a bit longer. Right, so that's the only solution. More money printing, which led us here. In other words, let's kick the can a little further. That would be the only solution right now, but it's temporary. So again, where does that leave us? It leaves us in a position of damned if you do, damned if you don't. And if you don't, it's going to be a lot more damned if you do when you do. Follow me? Speaking of all this, I saw an interesting conversation from little Timmy Geithner. Timmy Geithner sees some doom and gloom coming. And I want to get on that next. So my next video will be about that.